Let me turn to flows. Well, I got you here. This is one of the great expert in flows here. He covers it for Schwab here. We're still seeing money coming into ETFs this year, but it's interesting. Equities and fixed income are getting inflows, but not as much as we used to see in the past. So there's a little over 300 billion. I don't know if you can put up this full screen here. We've been used to seeing twice that amount in a historical basis. What's happening to sort of slow down the flows a little bit this year?
So, I've got the privilege to talk to a lot of Schwab clients. I travel, go to Schwab branches. I talk to advisors all over the country, and there's just a lot of uncertainty right now, right? Just think about what we're facing on the macroeconomy, right? Is the economy going to turn over to a recession? Or the political landscape and the upcoming election, commercial real estate. So all this uncertainty has anxiety, and when we see investor anxiety, generally we do see incremental flows slow. So it kind of makes sense. But as you point out, the flows into fixed income this year, over $100 billion into bond ETFs, that's an interesting thing, and it could be early days. There could be a lot more growth behind that. It was
the inflows into short-term treasuries were the big story in really the first 4 or 5 months of the year. That seems to have moderated a little bit. Talking to you here, one area we're seeing inflows into is intermediate corporate bonds. The Schwab 5 to 10 year corporate bond, SCHI, has been seeing inflows. That's surprising to me.
Material inflows, and to us it's heartening. But rates have gone up, and actually returns in a lot of fixed income, intermediate, long-term strategies have had negative returns this year, but not intermediate corporates, because the corporate spread has outweighed the rise in base rates. And so now, if you're looking at it now, intermediate corporates are yielding 5.75%. And that, makes sense for a lot of the U.S. American public, baby boomer generation ending retirement. We think they're under-allocated into fixed income, and 5.75% for term investments. And this is
that's
attractive.
Pretty darn good.
It is. Our strategist, Kathy Jones, and research likes it.
It's understandable that Sylvia, you see all these people happily sticking in these 5%, even 2-year. Returns at this point, and not jump. You'd think you'd get FOMO with the S&P up 16%. A lot of people would say, okay, I'm going to switch to the S&P. But a lot of people seem perfectly happy with their 5% yield after years of getting nothing on any kind of treasuries at all. So.
Yeah, exactly. I mean, but this is exactly why we did that, right? That's why instead of doing a covered call strategy where you're holding S&P 500 and getting 1.45% at best on your div, and then whatever you generate from covered calls, we put those short-term strategies in there, or there's short-term treasuries in there for that reason. You're getting 5% on that money. It's true. This year has been very much sit on the sidelines, a little bit of FOMO, and collect that steady 5 to 6% div. But I think a lot of the products coming out there are saying, let's give investors a chance to get outsized income, because that is essentially what they want.
You talk to Schwab offices all around the country. I know you're going to be leaving. We're in downtown Manhattan here, and you're going to be going to see some offices around here. What are you hearing from everyone? You're a good ear to the ground. Are there concerns out there? I mean, one of the most remarkable things this year is the soft landing is so far materializing, and everyone was positioned the opposite way 8 months ago.
Yeah, you mentioned the growth of the NASDAQ, right? I think the sharp uptick in growth strategies in NASDAQ and really that narrow leadership in the S&P 500, the top ones that have really led to it, that's caught people by surprise. But there's just not a lot of credibility behind it. A lot of people are worried, and that's that anxiety I talked to. So I think people are anxious, and they're really, people coming into Schwab branches, they're calling into our numbers, they're going online, really looking for guidance as to what's next. And again, we don't know what's coming in the next week or quarter, but we'll say focus on what do you want to accomplish in 5 years, 10 years, talk to a planner, have an overall asset allocation strategy, and ignore the short-term moves.
Yeah, the amazing thing is just how happy people are with these short-term treasury yields. My mother called me, I always make fun of this, in March and April, the end of March, and was standing there with the bank tellers saying, I can't believe it, Robert, I'm getting 4% on my 1-year CD. I haven't had that in years and years. I was getting 0.3% of my bank accounts.
That's right.
So she was absolutely delighted. And so I think one of the reasons it's been so sticky is people like my mother actually yanked money out of their savings accounts, not just out of their stock accounts, but out of their savings accounts. And that's why those numbers in money market funds are so sticky, with $7 trillion that we're seeing.